Everyone loves a safe bet, especially when it comes to property. We all want that nice area, steady growth, and zero stress. But what if I told you some of the UK's most popular safe havens are actually ticking time bombs? We've crunched the numbers, looking at hidden debt bubbles, stalling infrastructure projects, and misleading price growth to bring you the 10 UK regions that look perfect on paper today, but could wreck your portfolio by 2026. If you're thinking of buying in any of these areas, you need to watch this until the very end. Let's get into it. Number 10. Bournemouth, Christchurch, and Poole, BCP. Starting us off at number 10 is the coastal dream of Bournemouth, Christchurch, and Poole. On the surface, it looks like a winner. High demand, beaches, and a booming retiree market. But scratch the surface and the financial foundations are shaky. The BCP Council has faced severe financial warnings, flirting with bankruptcy notices multiple times. Why does this matter to you as a buyer? Because when councils go broke, council tax hikes follow and public services like waste collection and road maintenance collapse. Furthermore, local property prices are incredibly high relative to local wages, with the average house price sitting around 10 times the average salary. By 2026, as interest rates settle at higher norms, the affordability ceiling here is predicted to shatter. If the council cuts services while your mortgage costs stay high, that coastal premium suddenly looks like a liability. Number 9. Slough. Next at number 9, we have Slough. For years, investors poured money here, banking on the Crossrail effect. And yes, the Elizabeth line is running, but the expected boom has arguably already peaked and is now reversing. Slough Council effectively declared bankruptcy in 2021 with debts of £760 million, and they are now in a fire sale mode, selling off assets to balance the books. This creates massive uncertainty for future regeneration projects. The town centre regeneration plans have stalled significantly. While transport links to London are superb, the local environment is struggling with high commercial vacancy rates. The risk for 2026 is that you buy a commuter flat in a town that is actively defunding its own amenities. You're paying London-adjacent prices for an area with severe municipal austerity measures. The growth potential is capped by the council's inability to invest in the future. Number 8. Aberdeen. At number 8, it's the Granite City, Aberdeen. You might think, it's cheap, surely it's a bargain. The average property price is remarkably low compared to the rest of Scotland, which lures people in. However, Aberdeen is facing an identity crisis that will hit hard by 2026. The city's economy has been historically pegged to North Sea oil. With the UK government's aggressive push toward net zero and windfall taxes on energy profits, the oil sector is winding down faster than the renewables sector is ramping up to replace it. This economic transition creates a dangerous gap in the local job market. We are already seeing a stagnation in rental demand from high-paid energy workers. If the job market contracts further as predicted over the next 2 years, vacancy rates will rise, and capital appreciation will likely remain flat, or worse, negative, leaving you with an asset that's hard to sell. Number 7. Thanet, Margate and Ramsgate. Number 7 brings us to the hipster capital of the Kent coast, Thanet. Margate and Ramsgate saw an absolute explosion in prices post-2020 as Londoners fled the city. Prices jumped over 20% in short order. But here is the trap. That growth was driven by remote work, not the local economy. As major corporations mandate a return to office, RTO, that commute to London, which can take up to 2 hours door-to-door, is becoming a deal breaker. The local economy in Thanet is seasonal and low wage. It has some of the highest deprivation indices in the southeast. By 2026, if the remote work bubble fully deflates, Thanet risks an exodus of the very wealth that propped up its housing market. You could be buying at the absolute peak of a trend that is currently reversing, leaving you with negative equity in a seaside town with limited local employment. Number 6. Birmingham City Centre, specific new builds. Moving to number 6, we have Birmingham City Centre. Now, hold on. Birmingham is a major economic hub, right? Yes, but the danger here is specific. The oversupply of luxury 1- and 2-bed flats. Developers have gone into overdrive banking on HS2. But with the northern leg of HS2 scrapped, the connectivity promise has been watered down. There are thousands of units in the pipeline scheduled for completion by 2026. This glut of inventory is likely to suppress rental yields and capital growth. We are already seeing service charges in these new builds skyrocketing, eating into landlord profits. If you buy a generic new build flat here now, you are competing with thousands of identical units hitting the market simultaneously. The second city is growing, but the supply of apartments is outpacing the demand from qualified tenants who can afford the premium rents. Number 5. Cornwall, coastal villages. Halfway through at number 5, it's Cornwall. Specifically the holiday hotspots like St. Ives and Padstow. This looks safe because people always holiday in the UK, right? The problem isn't popularity, it's regulation. The government is cracking down hard on short-term lets and second homes. From 2025, councils have the power to charge double council tax on second homes. Furthermore, changes to the furnished holiday let (FHL) tax regime are removing the tax advantages that made buying here profitable. By 2026, we expect a flood of ex-holiday rentals hitting the market as amateur landlords exit the sector due to squeezed margins. This increase in supply will naturally depress prices. If you're buying here expecting the easy Airbnb money of 2021, you are walking into a regulatory minefield that will drastically reduce your net income. Number 4. Peterborough. Number 4 is Peterborough. It's often touted as one of the most affordable commuter hubs for London, with a 50-minute train journey to King's Cross. It looks like a math no-brainer, however, the social fundamentals are concerning. Peterborough has struggled with crime rates significantly higher than the national average in key areas, which caps the desirability ceiling for families moving out of the capital. But the real 2026 risk is economic. Peterborough has a heavy reliance on logistics and distribution jobs. As automation and AI begin to impact warehousing efficiency, the local low-skilled job market is vulnerable. Combine this with a stalling town center regeneration that hasn't quite delivered the gentrification promise of other commuter towns, and you have a region where house price growth is likely to lag significantly behind inflation. It's a cheap trap that might stay cheap forever. Number 3. Luton. Into the top 3, and at number 3 it's Luton. Historically, this has been a buy-to-let goldmine due to high yields. But the narrative is shifting. Luton regularly features on lists of worst places to live based on resident satisfaction surveys, which drives high tenant turnover. While the airport provides jobs, the transient nature of the population makes building a stable, long-term community difficult. The disaster looming for 2026 is the crackdown on HMOs, houses in multiple occupation. Luton Council has implemented strict Article 4 directions and licensing schemes. If you are buying here thinking you can easily convert a terrace into a cash cow HMO, think again. The regulatory cost is rising, and with mortgage rates stabilizing at higher levels, the margins in Luton are razor thin. You risk buying a headache rather than an asset in an area with a reputation ceiling it struggles to break. Number 2. Swindon. The runner-up at number 2 is Swindon. This town faces a significant structural economic challenge. Since the closure of the Honda plant, Swindon has been fighting to reinvent its economy. While there is talk of hydrogen hubs and tech, the transition is slow. The job market has lost a major anchor, and the ripple effects on local spending power are still being felt. For a buyer looking at 2026, the risk is capital stagnation. Swindon has an abundance of housing stock, but without a new influx of high-paying employers, there is no driver for price growth. It's a market drifting sideways. Additionally, the town center suffers from high vacancy rates that make it less attractive to the young professionals needed to drive the rental market. You might find a tenant, but you won't find the capital appreciation needed to beat inflation. Number 1. Central London, Zone 1 leaseholds. And finally, the number 1 region to avoid buying in by 2026 is Central London Zone 1 leaseholds. I'm talking about the older, prestigious mansion blocks and older conversions. Why? The leasehold trap. With the new Building Safety Act, The costs of remediating safety defects are causing chaos, and service charges in Zone 1 are spiraling out of control, some hitting £10,000 to £15,000 a year. But the 2026 disaster is the leasehold reform. While intended to help, the uncertainty around marriage value and ground rents has frozen parts of the market. Buyers are terrified of buying short leases, under 80 years, because the cost to extend is currently expensive, and the legislation to fix it is dragging on. If you buy a short lease here now hoping for a reform bargain, you are gambling on government competence. Combine that with a softening luxury market due to non-dom tax changes, and Zone 1 is a high-risk money pit. So guys, the UK property market is shifting. The safe bets of the last decade are becoming the liabilities of the next. Don't just follow the crowd, follow the fundamentals. If you want to know where the smart money is actually going in 2025, check out this video right here. And don't forget to subscribe for more honest property analysis.